Okay, so it's been a while since we've been here, but last time we had a lecture, we talked about the very beginning of the financial crisis, just the first couple slides. Um, First thing I wanted to note is that you can't blame the crisis on greed. That really doesn't tell us anything. Um, it's like an airplane crash, and blaming gravity for an airplane crash. Obviously, gravity is always present. That was definitely one of the causes, but it doesn't explain why it happened then. Why did things break down in 2007, 2008, as opposed to earlier or as opposed to later? Because greed is always present. Or self-interest. The more, I don't know what word I'm looking for. To say in a way that isn't as bad. Like greed, that definitely implies wanting to do better for yourself at the expense of everyone else. Self-interest is just the natural human tendency to want to do what's best for yourself. It doesn't imply not caring or benevolence towards other people. So what we want to investigate is not only why was this time different, but look at the institutional arrangements, look at the incentives that individuals within, whether it's government bureaucracies regulating the financial system or the financial institutions themselves, what incentives they faced. And was it a failure of the institutional designs? Was it a failure of commonly accepted banking practices? Was it just personal failures of individuals being too sure of themselves? That's something we need to understand. So the YouTube clip I showed was the beginning of Too Big to Fail, the movie. It showed Presidents Clinton and Bush II, talking about home ownership, how important home ownership, and they were both promoting bills they had just signed that helped to encourage home ownership. They got a really good quote from Bush when he said that it's not only good for the soul of the country, but also good for its pocketbook. The government had been encouraging home ownership for years, which you could suggest, one of the things that stoked the flames of the housing bubble. So we talked about the initial displacement that helps cause a bubble in the typical anatomy of the business cycle. One being financial innovation. In this case, mortgage-backed securities were blamed. So Ginnie Mae was created as a response to the Great Depression by Franklin Roosevelt. One of the ideas was they were in a debt deflationary spiral. Banks don't want to lend. So the idea was for them to buy mortgages from banks, get them off the balance sheet so that banks would be able to have that money to lend. Obviously, when there's a lot of systemic risk, a lot of uncertainty in the economy, banks aren't going to want to hold a lot of mortgages or a lot of any risky assets on their balance sheet. But mortgage lending in a debt deflationary spiral is extremely risky because as deflation continues, firms have to lower prices just to get the goods sold, and they're going to have to fire more workers because wages are sticky. They can't just cut people's wages. So they reduce labor costs by reducing the labor force they have. More people are unemployed. Those people are going to be less likely to be able to repay their mortgage loans. So banks are going to want to hold on as few of those as possible because of how risky they are. The response was, I don't want to say government agency, a quasi-government agency that would be able to pay banks, get those mortgages off their books so that they'll increase their lending. So they may only be willing to keep 5% of their balance sheet in like residential mortgages. But if they're able to securitize them and sell them to Ginnie Mae, then they can still end up lending to a lot more people, just not holding that risk themselves. 1968 was a date that Ginnie Mae was first guaranteeing mortgage-backed securities. Soon after, Fannie Mae and Freddie Mac were created and began doing the same. It's important to note that this was according to Hank Paulson, the Treasury Secretary during the financial crisis. He said that Freddie and Fannie securities move like water among all the financial institutions. This was pulled from Too Big to Fail, the actual book. Freddie and Fannie dominated the mortgage market. They had a huge share. I didn't write it down what the percentage was. By the 1980s, private lenders began officially offering mortgage-backed securities. And just to take a step back and define these, mortgage-backed securities are the rights to receive the value of a bundle of mortgages. So basically, you buy the right to a mortgage from a bank, and when that person pays off, every month their mortgage loan, you get that money. If you watch the J.G. Wentworth commercials, it's basically the same idea. So you have an annuity, so you got money coming in every month, but it's your money and you need it now. So you get a lump sum up front. Just like the bank that originates a mortgage gets a lump sum up front from the buyer. And then J.G. Wentworth, or the person buying mortgage-backed security, gets a payment every month. You can have one of Keely's finance classes, and she'll explain to you how to calculate the net present value. Obviously, you're not going to buy it unless you're going to make more money in the long run. So you have to factor in interest rates and expected inflation. But one party wants money up front, one party wants money stretching out to the future. So it's good. In theory, it's good for both of them. By doing mortgage-backed securities, by purchasing one, you're able to invest in mortgages without ever having to lend to a borrower. Lending to a borrower can be extremely time-intensive to go through their cash flows to see if they're an appropriate risk, whether the house is too expensive for them, whether you think they're going to repay or not. But if you think the mortgage market, the housing market is going to increase in value. If it's the market you want to get in, mortgage-backed securities is a great way to do it without having to open up a whole lending arm. I remember talking to my mom before, or I guess after the financial crisis, and she said before that she had noticed the money or the place she was paying our house's mortgage payment to changed several times, while they were paying off the mortgage through the 90s and 2000s. That had changed from one bank to another. She was kind of confused by that at first. So she called the bank. They're like, "Oh no, we bundled it and sold it." The reason why they bundle mortgages together is again to reduce risk. So if you buy just the straight up mortgage from someone, if that person, loses their job, can't repay, or can't pay their mortgage every month, you're out of money. You're not going to get anything back for it. But if you have you put 20 of them together, and then you buy 1/20th of it, you can get some from each of those people. So even if one or two can't repay their mortgage, you're still making at least most of your money back. So again, you're just spreading out risk. As time goes on, they figured out ways to reduce their risk even further by buying insurance policies in case those failed. AIG offered a lot of those, which is why they got in so much financial trouble during the crisis. There was ways to bundle mortgage-backed securities into larger and larger securities, and you would buy a smaller portion of that, all in ways to attempt to reduce risk. So when the bank makes that original loan and then sells it to an investment bank, again, this allows the investment bank to get into the mortgage market without having to create a whole new division from scratch. So it's a lot cheaper for them. but still a great way for them to make money. And it was thought to be safe. And this wasn't just by the financial industry that thought it was safe. Regulators on the national and international level also thought they were safe. So in the second Basel Accord that basically set the requirements for the capital that financial institutions had to keep on hand, they used what was called risk-weighted capital adjustments, where if banks had riskier assets, they had to keep more capital on hand as a buffer against those like falling in price. So say like a junk bond or like an emerging market economy, if their government had like a debt instrument, obviously it's a lot more risky than U.S. Treasury. So they, because they're more risky, had to keep more on hand. Whereas, U.S. short-term treasuries are about as riskless as you can get. So they had very low capital requirements for that. For highly rated mortgage-backed securities, they were also had one of the lowest amount of capital required to keep on hand because they were considered so riskless. So you can see as time goes on, that wasn't exactly the case. But the idea for the bank originating the mortgage is that by selling this mortgage-backed security, they could remove that risk in their balance sheet. So if something goes wrong, it doesn't matter to them because they're not on the hook for it. The investment bank adds a loan to a bundle of mortgages with similar interest rates, and then they can sell those. Fannie and Freddie bought and sold mortgages, and this was backed by the U.S. government. Okay, I'm afraid I had this on a later slide, but I'll talk about it now. The government did just more than encourage people to buy homes or like make it easier for them to buy homes. Beginning at some point in the 90s, Congress began requiring Freddie and Fannie to buy subprime mortgages. So because so many Americans own homes, it was seen as the path of prosperity. It's an asset that only appreciates in price in the long run. It provides stability, equity to borrow against. They wanted to encourage more and more people to own homes. So they began requiring Freddie and Fannie to own subprime mortgages. So subprime mortgages are mortgages with a higher likelihood of being unable to repay the full mortgage. It started out small. They just set us like a small percent, but by the end, by the financial crisis, they had grown to well over 50% of their mortgages that they held had to be subprime. So what does this encourage mortgage originators to do? The what? Yeah. So a bank isn't going to want to keep a lot of subprime mortgages on their balance sheet because they're so risky. But because you have Freddie and Fannie not just being willing to buy, but being told they have to buy them, banks are going to be more than willing. Think of it. They're going to be more than willing to loan to these subprime borrowers and get it off their balance sheet and get paid for it. It's virtually riskless for them. So they're gonna take advantage of it, and that's what they did. That's when the subprime borrowing really started to pick up. At that point, housing prices were appreciating, so people could put no money down on their mortgage. They could pay with a low rate, they call it the teaser rate for the first 2 years, and then it adjusts up to a more normal interest rate. At that point, they've been paying off their house for a little bit. They have some money in there. They can then refinance it and get better terms. So people are able to do that. They're able, stay in their homes, keep paying their mortgages, at least for the time being. Now these mortgage-backed securities were sold in the over-the-counter derivative market. What that means is they're not standardized and they're not regulated. these over-the-counter derivatives are like designed by financial institutions with just the assets they have, and they could take any form. They can have. There's no requirement for like a minimal amount or like, I don't know, the amount of risk involved in it. They don't have to conform to any certain standards. They can be basically whatever the both parties agree to, which is great for flexibility, especially for financial institutions that want to like hedge their investments. But the lack of standardization and regulation can make it difficult to value, especially if you're looking at another bank's balance sheet to determine, well, how much is this derivative actually worth, not what do they say it's worth. As things started to implode in the financial market, this made banks buying other banks extremely risky and take a long time because no one knew how to value the crap on their balance sheet. So by the 2000s, the mortgage-backed security market became competitive with a lot of financial institutions originating mortgages and then packaging them and selling them, and a lot of buyers and a lot of other financial institutions that were interested in purchasing them. Now I said a lot of how banks typically, I guess, use mortgage-backed securities is they would originate them, get them off their balance sheet. Well, a lot of financial institutions also kept them on their balance sheet, especially throughout as the 2000s continued. Goldman Sachs came under fire for basically creating a particular mortgage-backed security that they knew was going to fail and shorting it while like selling it to someone else who thought it was going to increase in value. So there was widespread perception that these financial institutions, especially about the mid-2000s, knew these assets were crap. But if you go through, especially like Lehman's balance sheet, they had a ton of mortgage-backed securities on there. So these firms really did, for better or worse, believe that mortgage-backed securities were safe, or more than willing to keep them on their balance sheet. Now, collateralized debt obligations were several mortgage-backed securities that were combined, and they had different tranches or different levels that you could invest in. So the investment banks that would create these CDOs would slice the bundles into similar risk categories. So you would have like extremely risky with like huge payouts, all the way down to the most safe with the lowest payouts. So what they would do, it was almost like these are, of course.
I think it's just a practical joke. They have markers in this room.
I know, I keep forgetting to bring mine. So basically you've got, let's say, your three tranches, from your safest, a medium risk, and then the most risky. When people repaid their mortgages and the money flowed to different tranches, I'm already halfway through it. The first one would fill up, the most safe one would get all their money. Then the next risky one would get paid, and obviously a higher interest rate. Then finally the last one gets paid, and they get the highest interest rate. When everyone's paying their mortgages back, this is great. You can invest in the riskiest level, and you're still going to make money on it. However, once people start failing on their mortgage or defaulting on their mortgages, then the lowest tranches, the highest risk tranches, start losing money, and they don't get repaid. Now, obviously, financial institutions like to hedge their bets to make sure that their investments aren't too risky. Make sure that in case of a downturn that they can at least minimize their losses. So to do this, especially those that bought the complex CDOs, and especially the riskier tranches, they bought what are called credit default swaps. And these are those insurance policies against the failure of a CDO. There were no capital requirements for credit default swaps. So AIG, who's issuing credit default swaps, didn't need to keep any capital on hand for it because they're considered insurance rather than like an investment vehicle. Insurable interest is not required. They were also exempt from regulation. The CFMA of 2000 now I'm blanking on what that stands for.
Construction Financial Management Association?
Commodity Futures Modernization Act.
That's it.
County Futures Modernization Act.
Yeah. So exempted them credit default swaps from regulation. Maybe not the best idea. And like I said, AIG, huge supplier in the market for credit default swaps. So mortgage-backed securities weren't all bad. There's a lot of good news. So it makes investing in the U.S. housing market a lot more accessible to both foreign and domestic investors. It allowed mortgage originators to basically take advantage of economies of scale. So they could hire on more loan officers that could originate the loans to do their due diligence to make sure the people applying for mortgages that their cash flows were enough to warrant getting a mortgage loan from them. And then they could turn around and, in order to reduce their risks, pull them together or just sell them to investment banks. It allowed foreign and domestic investors to be able to invest in the housing market. So by allowing foreigners to invest in the housing market, gives us an even bigger pool of money to loan out to people. And pooling mortgages could reduce risk through diversification. So we talked about the unit banking laws in like the 1800s, how banks were terribly undiversified. That the factory in the one town or the farming in that county, they have a particularly bad year, they have to lay people off, or farmers don't get enough money back, they default on their loans, and the banks fail. Well, by pooling mortgages from across the country, instead of just in your area, you're able to diversify further for regional risks. Obviously, the U.S. economy is more interconnected between regions today than it was in like the 1800s, but there still are regional fluctuations in demand. And if you can diversify to reduce the risk from those regional fluctuations, you can protect yourself more from those. The bad news is that its extreme complexity made it very difficult for buyers to understand what was going on and how risky the assets truly were. And it even made it difficult for the ratings agencies. The ratings agencies would literally go over the asset, like look through the mortgages that backed it up, and would not only assess its risk, but give it a risk ratings for people for investors to examine when they were thinking about investing in. So S&P and Moody's were the two big ratings agencies for years in the United States. So they would determine whether this particular mortgage-backed security being offered by this particular financial institution, how risky it was, whether it was like AAA, like the safest you can get, or whether it was, like triple B, or what's the lowest, like double C?
Does it go down anything worse than
It
that?
goes down like into the C's.
Maybe it's a
I think. Well, Moody's and S&P both use slightly different, nomenclature for theirs. Whether it's like double A plus for one, or like triple A, and that's like the highest. Whatever, but same basic idea.
AAA down to D.
Oh, down to D, okay. And that's Moody's or S&P?
That is S&P. Long-term issue credit rating.
The other bad news is that adverse incentives broke the tie between profits and risk taking. So because mortgage lenders, the mortgage originators, could get those mortgages off their balance sheet, it usually took about 30 days to get them off. That meant that they only had to ensure the creditworthiness of the borrower for 30 days. At that point, it's the other institution's problem. You can imagine what's going to happen in this situation. That the mortgage originators, they make money by originating as many mortgages as possible. And then they make money by getting them off their balance sheet. So they're going to do that, as many mortgages as they can, only to maximize their profit. And the riskiness of those mortgages don't really impact them because, for the most part, they're leaving their balance sheet. It's not the firm's or the bank's problem anymore. Because of that, we see a lot of subprime mortgages being issued. They call them ninja loans: no income, no job, no assets. These people were somehow able to get loans because they had enough money to make it through the first 2 or 3 months. By then, it was the problem of the second or third or fourth financial institution that ended up buying the mortgage-backed securities. And this is where we start to see the problems come in. Here we have the federal funds rate from basically the dot-com bubble through the financial crisis. What we see here during the dot-com bubble, the Fed cuts interest rates aggressively to try to deal with that crisis. It was a relatively short-lived recession. There was what they call a jobless recovery, where even though the economy improves, you don't see a large rebound in employment. In the past, if you had a sharp drop in employment, you'd see a sharp rebound right after the recession. We didn't really see that this time, but generally, looking at GDP, was a fairly smooth recession and back into the expansion phase of the business cycle. But from 2002 through 2004, you had the federal funds rate below 2%, approaching 1%. There were a few reasons for that. One was keeping rates low in the aftermath of September 11th. Again, dropping it for the dot-com bubble, just to help recover from the recession. Another, I wrote down exorbitant privilege. As Barry Eichengreen notes, having the US dollar as a reserve currency of the world tends to lower our interest rates relative to other countries. So we have, all else being held equal, we have US treasuries have lower interest rates than any other country. I think something like 80% of the $100 bills the Treasury prints are held by either foreign governments or foreign citizens. So that pushed down interest rates. And finally, fears of deflation by the Federal Reserve. They were talking about deflation in 2003 and 2004. That was something that particularly worried Alan Greenspan. Why about 2006 and 2007? Because they revised macro statistics, so unemployment, GDP, inflation. They go back and they revise them 6 months, 1 year, it's 2 years later to see what the actual level was for historical studies. Unfortunately, we severely underestimated inflation in 2002 to 2004. So when we thought inflation was down at 1%, it was actually closer to 3%. So the Fed didn't need to be worried about deflation, but they were at the time. So the federal funds rate, which was that 125 basis points? Or no, just 100 basis points, for almost a year. The real federal funds rate was actually negative because the inflation rate was higher. Had they known what the inflation rate actually was, they wouldn't have made it that low. Because of that, interest rates, a lot of Fed critics use the phrase too low for too long. They encouraged more investment than would be considered prudent with a more natural rate of interest. The Austrian theory of the business cycle focuses heavily on booms being manufactured by artificially cheap credit. Investments appear to be profitable in this like low interest rate environment, but as interest rates increase, say through 2005, 2006, see the federal funds rate steadily increase, those investments become less and less profitable and even unprofitable. And according to the Austrian theory of the business cycle, these malinvestments, once firms realize their unprofitability and they try to correct that, that's when we see the bust in the business cycle. The Austrian theory of the business cycle and the Keynesian theory of business cycles predicted or described the financial crisis pretty well. Keynes wrote his general theory describing what happened in the Great Depression. Austrian theory of the business cycle did a pretty good job of explaining the Great Depression. Since the financial crisis was similar to the Great Depression, obviously they're both going to also do a pretty good job describing that later. Another problem with low interest rates, not just the malinvestments. The Austrian theory of the business cycle, because it's very old, talks about like investment in like manufacturing for like capital goods. Low interest rates also have implications for financial markets. In this case, investors chose to what they call chase yield, because safe assets have super low interest rates and encourage investment into riskier assets in order to get a return, in order to try to maximize the return for their clients. As global savings saw higher returns than U.S. Treasuries, they turned to the housing market. Remember, housing rates were, or like mortgage-backed securities were considered relatively risk-free assets by international regulators. So banks are more than willing to shift into slightly riskier assets. I mean, they were a little bit riskier than treasuries, but they were largely rated at the same level. This idea is called regulatory arbitrage, where if you list several assets that you only need to keep 2% of capital on hand for instead of 10% on hand, you're going to shift your investments in like those assets into the riskier ones of that low risk pool. So they moved from treasuries that had, for almost a year, 1% to mortgage-backed securities. The 30-year fixed rate at this time offered generally 1.5 to 2%, so 150 to 200 basis points higher than treasury bonds. So this is a fairly significant return, considering how low the return on treasuries were. So by securitizing securitizing mortgages, that offered a channel for domestic and foreign financial capital to flow into the housing market. By having more capital on hand to be willing to invest in housing, more people can purchase housing. Banks don't just have to, the mortgage originators don't just have to rely on like the assets they have to back that up. They can get money from outside institutions, outside investors. So the housing market underwent significant changes from back in the 80s all the way up through the financial crisis. Back in the early 1980s, the 30-year mortgage rates were, they approached 20% for the best borrowers. I mean, these are the ones that are basically guaranteed to repay. It was still nearly 20% for them. Remember at the time, inflation was running at over 10%. So, and there was a lot of concern that it was going to go higher and inflation wasn't going to stop like it did. So, because of that, interest rates were extremely high. They fell fairly steadily from the early 80s to the 2000s. Once the period of Volcker disinflation, once it lowered inflation expectations, interest rates were able to fall back to more normal levels. And there was also the introduction of the adjustable rate mortgages, called abbreviated as ARMs. What they would do would have a low teaser rate. So, say for the first year, it's like a 2% interest rate, or first 2 years, 2% interest rate. Then after the 2 years, it increases to a certain multiple of either the federal funds rate or the LIBOR, which is basically the British version of the federal funds rate. Like the London, you remember, Max? We mentioned LIBOR in the paper, I don't know.
LIBOR is like it's a bunch of different.
Something overnight rate, but it's the same. It's just borrowing between banks to meet the
London
overnight capital
Interbank
requirements.
Offered rate.
It's
The interbank offer.
For changing it to SOFR.
Yeah, because they were caught manipulating the LIBOR.
Yeah. And it is really more, it's like the transition maybe could be rocky just because like all the terms of assets are like high, you know.
Yeah.
The LIBOR is wild.
Anytime they switch like that, it's interesting to see what happens.
Yeah.
Whether it's like pegging currencies or moving to a new interest rate.
I think it's already in effect now.
So adjustable rate mortgages were pretty smart. If you were a borrower, pretty smart in 1990. Because interest rates are steadily decreasing. So it's a good way to, I don't know, to be able to lower your interest rates or have a lower interest rate than if you just had a standard fixed 30-year mortgage. Basically, it's good anytime there's increasing home values and falling interest rates. It's obviously very bad in the opposite scenario. Yeah. So there were a lot of adverse incentives throughout the financial system leading up to the crisis. So first is the mortgage originators. As I mentioned, they did not keep their mortgages on their books. So they really didn't have an incentive to make sure that these were good long-run investments. As long as they were good enough, obviously good enough for the 30 to 60 days for the bank to get it off their balance sheet. But then once they were combining a mortgage-backed security, some failing wasn't even that big of a deal, because if you combine it, say, with 100 other mortgages, if one or two fails, it's going to be profitable. Not as profitable as it could be, but still fairly profitable. Next is investment banks. They sold mortgage-backed securities to investors. Again, they're not keeping all the mortgage-backed securities on their balance sheet. They're getting fees for selling them and for packaging them together. So they're not as worried about the long-run profitability of the safety of these assets. It turns out some of financial institutions either kept theirs on their balance sheet or bought them from other investment banks. Next is the rating agencies like Moody's and S&P that I mentioned. They're paid by investment banks to rate their assets. So what you end up with is a weird incentive structure where I'm paying you to rate my assets. if you give me too low of a rating, I could turn around and go to Randy and have him rate my assets. So you have the rating agencies trying to please the investment banks by giving them higher ratings or working together. A lot of times the investment banks, they would say, okay, what would you rate this at? And I say, oh, that's like a BAA, middle of the pack, maybe a little higher in the middle of the pack. And investment bank says, okay, well, what do we need to do to get this to a AAA rating? What do we need to do to make this safer or appear safer? And I say, well, if you want to meet that threshold, you've got to get rid of some of these mortgages and move on a mortgage with, I don't know, that meets these characteristics. And you have the investment banks do that. They say, okay, we take these off, slide those in there, rate it, they slap a AAA rating on it, and then they sell it.
Good stuff.
In theory, that could be good. They're using the ratings to make safer assets.
Yeah, safer.
Yeah, unfortunately, it's appear safer. And again, the investment banks and the rating agencies don't really care as long as they appear safe. They appear that they're doing their job. As long as housing prices are increasing, interest rates are stable, there's not going to be a ton of defaults. So they don't need to make sure that these underlying assets are truly safe. Just enough to keep going while we have momentum. More adverse incentives coming from Congress encouraging home ownership, especially for low income. Obviously, there's the tax credit they give to homeowners for their mortgage. They do a lot of other things to encourage home ownership. Requiring Freddie and Fannie to purchase subprime mortgage-backed securities. And finally, the regulators. There's the idea of the revolving door, that people leave investment banks, they leave financial institutions, and they go work for the government. There's a joke, I'm calling Treasury Government Sachs, because so many Treasury officials came from Goldman Sachs. During the financial crisis where Hank Paulson at the Treasury Department, Tim Geithner at the New York Fed, Ben Bernanke, the FOMC, when they're trying to go in and save financial institutions or match an investment bank and a commercial bank together to try to shore them up. Because Paulson worked for Goldman Sachs, he couldn't get involved directly with any of the Goldman stuff. So he'd have to direct subordinates to do that. Meanwhile, he's talking at least once a day, he's calling Dick Fulton for 3-4 months. There's also a multitude of regulators overseeing the financial system. It could be good that in theory, it could be good that they're able to recognize each other's mistakes, or they're able to focus in on one specific area. So one group of regulators just looking at capital requirements. Other ones just looking at how interconnected the banks are. Just looking at the safety mortgages. That could be good, or it could be bad. You have regulators not talking to each other. Maybe they know some problem and say, well, that's not my area, so they don't flag that for the other agency. Government agencies don't have a good track record of sharing information with each other. Shouldn't be surprising. Firms don't really have a great track record of sharing information with each other. They have their own silos, these government agencies, and they don't know each other. Like SEC and Treasury don't hang out all the time. They don't play in the same corporate softball teams. It's kind of sarcastic, but they don't communicate with each other very often. They don't know who each other are because they're different agencies. So it makes it tougher for them to communicate with each other. And finally, Basel Accords. Basel II had lower capital requirements for highly rated mortgage-backed securities, and then encouraged these banks to invest in highly rated mortgage-backed securities. You have to keep less capital on hand for certain asset classes. You're going to tend to invest in those asset classes. Okay, we're going to stop here for the day.